opportunity for home ownership for all Americans has been a long-standing national goal. Interest rates were low and the price of property was ever increasing. It seemed like a risk-free bet. The subprime mortgage market is aimed at providing housing finance to disproportionately poor and minority people with some combination of spotty credit histories, a lack of income documentation, or no money for a down payment. So basically, instead of lending to more responsible candidates, banks decided to look for less responsible loanees. Historically, this group was perceived by banks as too risky to qualify for the usual mortgage products, so the banks had to figure out new ways to loan to them. This was accomplished with a fixed initial period interest rate, but then having a reset date, where the interest rate would rise significantly, essentially requiring the borrower to refinance the mortgage. There were low initial interest rates, but once the teaser rate finished, the interest rate could increase dramatically, leaving no room for the unexpected, such as a job loss or changes in the market. The innovation was a success, if measured in terms of originations. In the years 2001 to 2006, a total of about $2.5 trillion of subprime mortgages were originated. Not only did subprime become a large part of the property market, but through the invention of complex financial products such as collateralized debt obligations, or CDOs, subprime became a large part of financial markets in the process. Mortgages were pooled or grouped together and sold off in portions, or tranches, to individual investors, a process known as securitization. This enabled banks to remove the risk of the mortgages from their balance sheets and enabled investors to choose what level of risk they wanted to take in return for a given level of return. A ratings agency was employed to determine how likely it was that a pool of mortgages would repay their debt. In theory, this was a win-win for all parties. Investors received an interest payment, and in the event of loan repayment default, the debt was secured with what was often property. And property prices were only going one way, right? Add to this the outdated and inept models used by ratings agencies to rate the pools, it's easy to now see the problems brewing. Investors place their trust in investment banks, who in turn place their trust in the ratings agency, who passed that on to homeowners. The entire system was based on market confidence, which showed no signs of waning. Not everyone was so confident about the meteoric rise of the housing market, and looked for a way to minimize their losses if a crash was to happen. This came about in the form of the CDS, or credit default swap, which acted as a type of insurance on CDOs. If a CDO was to default, the holder of CDS would be paid compensation. Oversupply of new homes began to glut the market. It was Econ 101. Supply was far greater than demand, leading to the decline of US home prices in mid-2006. At the same time, mortgage rates began to reset to higher levels. Borrowers, particularly subprime borrowers, began defaulting, often owing more than their homes were worth, or unable to support their higher monthly payments with their current incomes. The inability of subprime borrowers to repay their debts resulted in holders of CDOs not being paid for the loan they now essentially owned. Failing to repay the holders of CDOs triggered a default, resulting in the payment to those holding CDS protection. AIG and many other insurers who had underwritten the CDS contracts then had to pay out on the defaults. The triggering of billions of dollars in CDS contracts resulted in the collapse of AIG, as it was unable to repay such claims all at once. While at this point the crash was limited to the property market, people were spooked and wanted to make sure that their money was safe, which made them very reluctant to lend to anyone. Many businesses rely on short-term loans in order to provide goods and services that they will later sell. Liquidity refers to the ability of these companies to take out debt to finance their operations. When there is not enough liquidity in the market, these businesses start to shut down, which was beginning to be the case. Investors sought only to hold very short-term assets, which caused the crisis to move from institutions that were directly exposed to the US subprime market to those that relied on short-term financing to fund their operations. The US credit bubble and subsequent crisis emerged from a misunderstanding of the liquidity and credit risks associated with an abundance of complex, relatively new financial products. The US crisis precipitated a global liquidity crisis. This was not just happening in the US. Similar conditions led to crashes all around the world. With the advent of the single currency in January 1999, every Eurozone country suddenly shared a single interest rate. This was great for countries with less developed economies, like Ireland and Greece, who could now borrow at the lower German interest rate and boost their economies. As it turns out, the American dream isn't quite so American. The availability of cheap credit spurred a boom in property development, with over 93,000 houses being built per year at its height, the equivalent of one house per 45 people, and 12.6% of the workforce was directly employed by the construction industry. One of the key issues with this was who was building these houses. Regulations allowed property developers to take out mortgages against these houses with the same conditions that a resident could. Investors saw the opportunity here, and 27% of mortgages were to investors. Naturally, an investor doesn't have the same personal investment in a house as a resident does, and as a result is less resistant to shocks. When the housing market shuttered, the property developers all rushed to get out at once. This sudden surge in housing supply was too much for the market to take, and house prices fell off a cliff. The bubble had burst. This was the homegrown aspect of the assault on the banks of Ireland and other EU countries, but there was an imported factor as well. The European banks had huge exposure to American CDOs and assumed that they were basically riskless. As a result, when the international housing market collapsed, the banks were hit on two fronts. The Irish government saw the need to restore confidence in their banking system and guaranteed every bank account to the tune of €100,000, a move that was recently described as the most destructive own goal in history that sunk an entire nation. This guarantee effectively transferred the Irish banks' bad debts to the government and ruined their reputation on the financial markets. Unable to borrow at reasonable rates and trying to support an ever-increasing budget deficit, the Irish government was on the verge of declaring bankruptcy before being bailed out by the Troika, an umbrella term for the triumvirate of the EU, European Central Bank and International Monetary Fund. Ireland had a strict bailout programme with years of painful austerity, but it is now starting to emerge from it. However, the scars from the misguided mirage that was the Celtic Tiger still remain in the form of crippling national debts, emigration of the young and educated, and deserted ghost estates populating the countryside.